Yeah, I mean, it was. I remember going to that conference with you. It was pretty interesting. We met some really cool people for sure. You among them, and it's really nice to be able to meet some of the other content creators out there on the web and build a relationship. Actually, Jennifer, we had dinner a few weeks ago when she was in Dallas, and we were talking about some of what she's got going on and what I got going on, and made some introductions to other people during that. So it's really awesome, what you really have created in the network that you're building. So I think that's pretty awesome. So
Yeah, thanks. Well, it's great. I think, when you can bring a community of like-minded people together, there's always something to learn, right? There's always, everyone has different techniques that works for them. And so that's really what I love is getting everyone together, kind of learning from each other and collaborating and yeah, just figuring out how to do some deals and have the lifestyle that you want. And
yeah. So anyway, I really appreciate you inviting me to talk about this. And I know you say you're not qualified for it, but I think you're more qualified than you think, based on how I know you. But so we're gonna talk tonight. So we're gonna talk about what I like to call the four secrets of commercial multifamily property. And honestly, these secrets can apply to a lot of real estate and just a lot of life in general. But we're going to get really deep into some actual analysis of some deals. But you really have to understand these four fundamental secrets about it. But first, I just want to make sure that you're in the right place and that I'm talking to the right people. This is really for anybody who wants to replace their active income with passive income using commercial real estate. So in a nutshell, if you're trying to replace your job with more passive income, or if you're trying to just diversify some of what you have into larger assets, move them out of single family and into commercial real estate, then you're really the person that I'm trying to talk to. So if that's you, then you're definitely in the right place. The next 45 minutes, we're going to talk about the step-by-step system to analyzing any commercial multifamily property. Now, as you know, we're only going to be talking about this for 45 minutes to an hour, and people can literally talk about this for days. So we're not going to get into every single thing that you could possibly need to know. It's just impossible. But we're going to touch upon the really important stuff. And if you take some notes on this, it's really going to help you in your analysis when you're looking for deals across the country. I'm going to teach you how to do it without being a spreadsheet geek like me, because honestly, that's me. I can look at 3 or 4 spreadsheets up on I have multiple monitors, and I'll literally have 3 or 4 spreadsheets going at the same time because I'm a total geek and I love that stuff. But I'm going to teach you how to do it without being like that, because most people are not like weirdos like me. Without knowing advanced calculus. Now, of course, you don't need to know calculus, but a lot of people are afraid of math and they're afraid of these things. So we're going to talk about how easy ways to really run through the numbers without knowing really advanced calculations. And most importantly for you is how to do it without being a full-time real estate professional. People like me and Jennifer, we live and breathe this stuff from the moment we get up to the moment we go to bed. All we think about is real estate. But most people are not like that. Most people want to invest in real estate because it makes sense, but they have other lives and other careers. So how you can analyze these commercial multifamily deals without being full-time real estate professionals. I'm also going to talk to you about why commercial real estate is better than residential real estate. And I'm going to tell you how you can invest in deals way bigger than you think you can get. Many of you are trapped in kind of inside the box, and I'm going to show you how to get outside the box and get into way bigger deals, just like Jennifer got into a 192 unit deal. We're going to talk about that a little bit tonight, how you can go from doing 3, 4, 5 family type stuff, 7 family, all the way up to 50 or 100 unit deals, and it's really not as hard as you think. Now, does this sound like you? Are you currently investing in single family, duplexes, triplex, whatever, residential, and you're just not seeing the returns you want? Are you realizing that you're more involved in the deals than you ever wanted to be? You want to be more passive in your investments, but you're just not sure how to go about it. You bought those properties, or you bought those properties thinking that they would just be passive income, realizing that there's way more work involved than you ever thought or anybody ever told you about. Or you would love to invest in multifamily, but it seems too expensive, too far away, or just way too big for what quote unquote normal people are supposed to go after, right? Well, the problem is you don't know the 4 secrets. And once you know them, once you follow them, you're easily going to be on your way to a 6-figure passive income or more. Really, the sky's the limit. Wherever you want to go is where you can get. Once you know them, you'll know exactly how to find deals to invest in, right? Everybody complains. They say it's a hot market. There's no deals out there. I just can't find any deals. Once you know the secrets, you're going to know how to find those deals. You're going to be able to run the numbers on any deal and not worry about making big mistakes, right? Because you make a mistake on a $100,000 deal, and then if you do a $5 million deal, all those mistakes get magnified. So we're going to try to not make those mistakes. And you're going to, like I said, you're going to be able to invest in way bigger deals than you ever thought possible. And people will look to you as the expert, right? That's ultimately what we want. We want people to come to us as the experts. Now, who am I? I know Jennifer gave me an amazing introduction, probably talked about me better than I could ever talk about me. So, but I'm the founder of idealrei.com, and I currently own approximately 470 doors in 2 states. I bought my first triplex in 2009. It's a 3-family. I lived in it, and it's a great way to get started in real estate. If you don't have any property, I highly, highly recommend buying a 2, 3, or 4-family residential property and living in it, and getting that rent to pay for your mortgage. Now, many of you are way beyond that, but that's how I got started, and I highly recommend it. I was in a PhD program. That's where I met my wife, and we both studied for our PhDs in economics. And you know what? I did something crazy. I dropped out in 2011. My professors thought I was crazy. Literally sat me down and said, "You're dumb. Don't do this." And I said, "No, I want to get into real estate full time." That's because I deployed to Afghanistan in 2010. I came back in 2011. I had a lot of money saved, and I spent the whole year reading about real estate in between missions and stuff like that. So all I want to do is that. Well, you want to know what? Guess who was right? I retired from work in 2016. I was 30 years old when I essentially retired. And this picture right here, that's a picture of me a few years ago. I don't look like that anymore. That's a lot younger. That photo was taken of me on the last day of work ever. That's why I'm so happy. I was in work that day. People were telling me I was beaming. Everybody was saying, "Man, you just look so good today. What is it?" Well, I didn't tell them because I'm kind of private in my life. I was retiring, and that's what a retiring person looks like. Has a giant smile on their face the whole day. Bottom line, the 4 secrets that I've discovered over the last 10 years, and I'm going to share with you. And you can go from $0 to $1,000 a month, or to $5,000 to $10,000, or whatever your goal is. You can take these, and then you can just expand upon them to get to where you want to go. If you know these and follow these, you're going to find yourself growing. Now we're going to start with the number 1 secret that they won't tell you, whoever they is, the people who have secrets, right? The number 1 secret that they're not telling you. And this is the key to immediately separating yourself from your competitors, even if they have more cash, more resources. Some of you are probably just getting started, and you feel like your competitors get all the deals, they have all the investors, plenty of money to buy all the deals, they have 1 million followers, and you're sitting there thinking, "Man, how could I ever possibly beat them?" Right? And I'm sure all of you know that person in your market. That guy or that girl has just got all the deals, and everybody knows them. Well, here's how. Here's the key. I want you to read this. When somebody asks you, "What are you doing to grow your business?" how do you reply? Take a second and think about that. If you're at a meetup and they say, "What are you doing? How are you growing?" what do you say? Right? Are you saying, "I'm searching on MLS, I'm working with a real estate agent, I'm looking at Craigslist, for sale by owner, LoopNet," whatever it is? Is that what you say? That's what most people say. Well, if you are saying that, you're leaving so many deals on the table. Because here's the secret. It's all about relationships, and I want you to write this down. Right? This is the most important thing. If you left right now and you just remembered this, you're going to grow. You'll never reach your full potential unless you focus everything on building relationships. Right? Real estate is the one industry that will never be replaced by machines. It will just always be that way. It'll always be based on personal relationships. Right? And I spent years thinking that I should avoid other investors because they were going to steal my deals, or they're going to steal my ideas. And it took me years, literally years, and I realized I was completely wrong. And then once I really started growing relationships, my business just exploded, right? The best deals are never marketed. They're never sold because you know somebody. The best financing is always private. It's always person to person. Once you build those right relationships, everything else falls into place, right? Now, I know we're going to get into the numbers and stuff later, but none of that matters if you're not building relationships. Everything will fall into place, right? So let's just talk about this pyramid real quick, right? So strong relationships are built slowly, and they start by having a strong knowledge base. See how all the knowledge and information we're going to talk about in a second ties into building relationships. You're going and meeting a person. If you don't have a strong fundamental knowledge about the industry, people aren't going to want to talk to you. They're going to say, you know what, I'm too busy. I don't have time. You're too new. Come back to me in 6 months when you know more. I can tell you, I'm guilty of that. I'm guilty of that. I remember at meetups that I have a very specific memory of this kid. He's like 20, so motivated, wants to get involved in real estate, but he has zero knowledge. And I just don't have enough time to spend on relationships where people need me that much. I really need relationships where people are have a little bit more knowledge, and we can kind of build each other up, right? That's just where I'm at in my business, right? So you got to build that foundation of knowledge. And if you're in commercial real estate, you have to understand that. And then, in my opinion, I believe that what's built upon that is empathy. Empathy towards their family, toward a business. Secret is to choose your market, and don't let the market choose you. So let's ask, what is the right market? Well, that's the wrong question. Forget about that question for a minute, okay? See, that's what everybody's thinking. Where should I invest? The question you should be asking is, how do I not get trapped by geography, right? Don't focus on investing where you live. Focus on finding markets with good fundamentals. Now, most people are trapped in so many different ways. They're trapped based on their current location. They're trapped in their own mind, just that they can't invest in something that's too far away because they feel like they can't see it. Whatever it is that's holding a person back, they're trapping themselves. And most likely, you may live in a market that is the best market to invest in ever. It's possible. Obviously, people live there, right? So you may live in one of those great markets, but chances are you don't. And so you can't get trapped by that. And that's one of the biggest hurdles that people have to overcome, right? And another thing is that people invest in places where they know other people, and that's okay. But don't invest just because that's the only market where you have connections, right? You may want to invest in, I don't know, whatever, Ohio or Tennessee. Don't invest there just because you have family or friends there. That's crazy, right? Invest there because it has good fundamentals. Instead, focus on building relationships in the market. Determine the market you want to go in, and then build the relationships there. And that's what's awesome about what Jennifer is doing, right? And that's why we connect so much on these things. With her company, Agents Invest, and I absolutely love it. Like, I literally love the idea. I want to take it for myself, but I can't do that, right? I'm just kidding. She's building a network for you. And there's a huge benefit to having her in your network, because when you add her to your network, you can then leverage her network to help you grow. And that's how all about relationships, right? So it's so awesome on what she's doing. And that's something that if I knew somebody like Jennifer 10 years ago, I would own a totally different set of investments than I own today. So that's really awesome. So whatever it is, however you're doing it, find the market that you want to be in, and then build the relationships in those markets by leveraging your current relationships with other people. And that's the fastest way to grow. That's the secret. But let's talk for a second about market fundamentals, right? Because it is important. I know I just kind of put a big giant red X in the middle of that. It is important. So some things that you want to look for. State, city, population, employment growth, right? This is the first step of your analysis. You want to know what the state and city population employment growth is, right? So there's a lot of fundamentals about a state or about a city or a particular MSA. And there's literally hundreds of data points that you could be looking at. But my favorite data point, my favorite thing to look at is population growth, because it's a proxy for all those other things. If there's good schools, people move there. If there's good employment, people move there. If there's good environment and low pollution, people move there. If there's low crime, people move there. That's just natural. People want to be where it's nice. If it's got bad jobs, bad environment, high crime, people move out. That's just because people don't want to be there. So they buy houses or rent apartments not there, and they move. So city population growth and state population growth, or the growth of the entire MSA inside that in that state. Many states have multiple MSAs. That's a good proxy for everything else. So if you aren't a huge numbers person, look at the city and look at the state. If they both got good population growth that are at or above the national average, then that's probably a solid market to invest in. So submarket population, employment, demographics, I just jumped ahead of myself and I already talked about number 2. So you want to look at the state and you want to look at the submarket. So if you're in a, so I'm living in Dallas right now. So DFW is a huge market with about 7 million people living in it. Now you got the Dallas submarket, you've got the Fort Worth submarket, you got the Mid-Cities submarket, the north side of Dallas, so on and so forth. These are all submarkets where people live, and you're getting entirely different groups of people in them. The north side of the city, white collar. South side of the city, blue collar, right? Certain parts of the city are mostly Section 8. You know what I mean? So like different parts of that, and you got to know the individual sub-market. So even if you decide to invest in Atlanta, that doesn't mean all parts of Atlanta are worth investing in. You got to figure out what sections of it you need to invest in, all right? And then you need to dive down a little bit further and look at the specific neighborhoods, crime, traffic, and class. So class, in this sense, is A, B, C, or D. Right? So A-class properties are your newest, usually built within the last 20 years. B are 20 to 30. C-class are 30 to 40. And D-class are usually older. Now, this works in many markets. It doesn't work in all markets. Like I'm from New England, and pretty much all properties are 80 to 100 years old. So this whole thing you just got to toss right out the window, and you kind of got to figure it out based on when it was last renovated, the quality of the neighborhood, the quality of the finishes. There's you got to get a little bit more detail. It's a little bit more complex. But usually New England is not a great investor market, so you're probably not looking there anyway. But if you are anywhere on the East Coast with older housing stock, you got to take the age thing with a grain of salt and really look at more at the property in its area. But here's another thing that I want to talk about real quick. There's no set of rules to follow, right? Everyone has a different set of criteria. I was literally just on Saturday night, I was having a conversation with someone, and one person thought Memphis was the best market to invest in because the returns were high. Another person said that's way too risky. Look at the fundamentals, and they were having this detailed argument about the criteria in Memphis and if it's good or not. And so the point is for one investor, Memphis was an amazing market. And for another investor, it's a really horrible market, right? Because risk is perceived or mitigated based on who you know there and a lot of other things. So if you know a good broker, good property manager, you have boots on the ground and all these other factors, then maybe you can turn a really bad market into a really good market because you've mitigated most of the risk factors. If you don't have those relationships on the ground, then even a core market might have a lot of risk. So you could say, well, how can you lose in Dallas, right? Everybody's investing in Dallas, crazy growth. Well, if you don't have the right relationships in Dallas, you'd be better off investing in some crap in Chicago or Detroit if you have good relationships there, rather than just with no relationships investing in a hot market, because you don't know the fundamentals in that market. So you got to start by building those relationships. So the point, to bring it back around, there's no set of rules on what's a good or bad market. It depends on you, and the relationships that you have in that specific market is what determines if it's a good or a bad market. Don't be afraid to partner. Now, when I got started, I was a lone wolf investor. Like I told you, I didn't believe that I should share my knowledge. I didn't believe, excuse me, that I should talk to anybody about my deals. I thought they were going to steal from me my deals. If I talked about a specific property, they were going to take it from me, right? So partnering was the last thing on my mind. I did everything. And I want you to think beyond your scope, right? So let's think about all the different things that you have to do. Management, capital improvements, find deals, do your deal analysis, bring your own capital, have net worth and liquidity. Now, I'm just going to pause there. I'm going to digress for 1 second. In commercial real estate, it's a little bit different than residential real estate. When you do a loan on a commercial side, you have to have the net worth that generally is around the loan value. It could be a little bit less than the loan value on smaller deals. And you have to have liquidity equal to 10% of the loan value. So if it's $1 million loan, you have to have $100,000 cash in a bank, or they won't give you the loan. So I'm not going to dive into that. It's not the purpose of this This webinar is not to go into commercial finance or anything like that. But if you're doing it on your own, you got to bring all that net worth and liquidity on your own. Look at this. Somebody needs to fill all of these roles and more. And do you alone have what it takes? Maybe, yes, it's possible, but it takes years to become an expert, right? It takes years. They say, I forget what it is, some number of thousands of hours that you have to do on one specific thing in order to become a true expert at it. And do you think you'd be better or worse by partnering with people who are actually experts in any of those other areas? If you could bring people into your deal, or you could join other people in their deal, where you're an expert in one thing and they're an expert in another thing, do you think that you'd be better or worse by working with them? Of course, it's like the answer is obvious. You'd probably be better off. Now, I mean, that's not to say all partnerships are great, but chances are you'd be better. Now, there's really 4 ways to partner, right? Now, this is really important for deal analysis because you're going to analyze your deals completely different depending on how the deals are structured. That's what I'm talking about. I know I'm bringing a lot of different things in to talk about deal analysis, but it all comes together kind of at the end. So you got to really think about how you're going to structure your deals. Now, are you doing it alone? You're going to analyze it in one way. Are you bringing in equal partners? You're going to analyze it another way, right? So equal partners, or what I call equal partners, where you have one or more people that form a partnership. It's what you normally think of when you think of partners. They split the deals based on their agreement. Now, it's usually 2 or 3 people, and they work their asses off together to make something happen, and that's what they call their partner. Now, the pros of this is they share all the results. They have more than one mind working on the problem. But the problem is you have to bring all the capital, skill, and dedication. You don't have other partners to lean on. And often there's conflict because if one partner is really motivated and the other one is not, then one person works really hard and gets bitter and angry at the other person. Or sometimes 5 years later, life circumstances just change and one person, whatever, has a sick family member, whatever it may be, they can't dedicate the time and energy into doing the deals like you are. But they're still getting the same percentage that they always got, right? So that's kind of leads, a lot of times partnerships fall apart. Another way is being a deal sponsor. Right? And this is where you lead the deal and you find junior partners to fill those roles. When you need other experts to find deals or bring capital or whatever it may be. I mean, there's a lot of different things that people can fill, management and stuff like that. Right? So you're gonna find the deal. No, you're going to be the person who puts the deal together. You're the main person behind the deal, and you're taking all these different people to fill these roles. Okay? The partners include deal finders, key principal, right? Key principals can bring that net worth and liquidity. Asset manager, a person who oversees this property and its construction and stuff like that. Your equity investors, the people who are investing passively, like Jennifer invested in a deal that I sponsored. She's one of the passive investors, and she brought capital to the deal, and I was a deal sponsor. Pros of this is you get extra equity and extra returns, which is awesome, right? That's what we're all looking for. But you accept most of the risk. If there's a problem, you're the one who gets wiped out first. Anything goes wrong, whatever. Something like these are the people, when you see people like go to jail for fraud and stuff like this, deal sponsors. Okay, not obviously you shouldn't do fraud, but the people who accept all the risk are the sponsors themselves. Is the point of it. Now, you could also be a junior partner. Now, this is where you work with a deal sponsor, and you got to bring some kind of value to them. Right? Now, the pro is that you gain some equity ownership in a deal and you have very limited capital contribution, right? Con is you have to have a skill to bring to the team. If you don't really bring something very specific, you're not going to get onto anybody's team. So if you're in a situation where you don't have a lot of money, but you've got really interesting skill set that you can bring to the table, then you should approach a deal sponsor and say, hey, and pitch them an idea. And many of them will say no, but eventually you find a deal sponsor who needs your set of skills. And honestly, this is how I got into my first deal. I became indispensable in deal analysis. I became the go-to person for analyzing deals in the Dallas-Fort Worth market. I knew every single deal that was in the market at all times. So anybody that I knew that wanted to ask a question or had anything about a deal in Dallas Fort Worth, all they do is call me because I already knew the answer. I literally knew every single line on every spreadsheet. And that's how I got myself to a point where somebody said, hey, why don't you join us on these deals because you know what's going on. And then the fourth way is to be an equity partner. And that's where you find a deal sponsor, invest your capital with them. And the benefit is you get to leverage the skills of somebody else. You earn in the equity partners earn the majority, usually around 75 to 80% of the returns. They earn most of the money. The other 20% or so goes to the deal sponsors, this deal sponsor team, but the equity partners earn almost all of it. The negative, the drawback, is you have limited say in the operations. All right, we're going to dive into the numbers now. The longer you do real estate, the less involved you want to be with what you're doing. I don't know about you, but I know you have a little bit different niche in real estate than I do, but dealing with tenants grates on me, especially after 10 years of doing it. I hate dealing with them. I mean, you don't deal with always the highest quality people, and it just eventually you don't want to deal with that. And the more money you make, the more you have, the harder it is to find a good place to put that money. And so honestly, the more money you have, the more you invest, the more you do, or the busier you are, the more you want that money to be passive. And I'll pass up a 15% return that requires a lot of time to take an 11% return somewhere that doesn't require a lot of time, and, or even less if I don't have to do anything at all, right? So I think it makes sense, and I think it really depends. What I usually tell people when they ask me is I say, if you have a lot of time and not a lot of money, then you should be very actively involved in real estate. But if you have a lot of money and not a lot of time, then you should probably be more passively involved in real estate, because you should make your money work for you, and you should do what your skill set is, whatever that may be. A lot of people, for example, that I know that are investors are in technology or engineers. They have so much money and they make so much money on whatever they're doing. It wouldn't make sense for them to get into real estate full time. It really wouldn't. And so they can put that money over, make very good returns in real estate more passively, and they can focus on earning their money there, put in real estate, and it doesn't take them very long until they've replaced their income with passive income. So I think if you look at it from a different perspective, it makes total sense. Let's get into the secret number 4, knowing your numbers, right? And this is really the meat and potatoes right here. And this is the hardest part. Every investor needs to have an understanding of the numbers, but you don't have to be crazy spreadsheet geek like me. You just have to be able to work through the numbers, work through the pieces, and get some honest results. That's what you have to be able to do. You don't need to know if a deal is worth 1.1 million or 1.15 million, because honestly, chances are that 0.05 is not going to be the difference between you succeeding or failing on your deal. It's just not. People like me really like to hone in on it because I'm just like weird. And here's the thing: if you aren't sure about something, bounce it off of somebody else. Bounce it off a broker, a property manager, or another experienced investor like Jennifer or myself or other people, right? Because that's where those relationships help you. So the 4 fundamentals of deal analysis, right? And you probably already understand them as the fundamentals, but have never really called them that. You need to know your rents, know your operating budget. You need to be able to estimate your rehab cost and determine your market value. You cannot analyze a deal without those 4 pieces. But first, real quick, we're going to talk about cap rates. Cap rates are how deals are analyzed in commercial real estate versus doing comparative analysis or comparative market analysis on residential. Totally different way. And I gotta do it up front. So what a cap rate is, you hear this number tossed out. It's an 8 cap property, or it's got an 8% cap rate, or 10 cap, 5 cap, whatever. You hear this number tossed out all the time. The really, really easy way of understanding it is if you paid all cash for a deal, this is what your return would be. So if you received $10,000 a year after all expenses are paid, all your management, all your utilities, everything except your principal and interest, because cap rates do not include principal and interest. If you paid $100,000 cash for that property, then the cap rate is 10%. right? Now, just real quick, a note: lower cap rates mean higher prices. You have to, if you paid $100,000 and you only received $5,000 a year in cash flow, that'd be at a 5 cap. If you wanted to get $10,000 in return, it would be the exact opposite. So the lower the cap rate, the higher the prices are compared to the income that you're receiving. So let's dive into knowing your rents, right? And we're not going to dive into this too much because you could spend an hour just talking about how to analyze rents. But you get to do a lot of research and feel comfortable that you know what the rents will be. And it's always better to be conservative than be aggressive on your rent assumptions. And never, here's the key, never assume a huge rent bump in year one. So you're buying a property, rents are at $500 a month. You think, oh, market rent's $1,000 a month, so by the end of year one, we'll be at $1,000 a month. Just don't do that. That's crazy. To get a double your income, especially in a property of any decent size, you can't just empty it out. You can't take a 100-unit building or a 50-unit building and vacate it. You just can't. You got to slowly do it. And you want to know what? People who are paying $1,000 a month don't want to live next to people who pay $500 a month. You just can't do that. So you got to slowly move them. You got to turn it from 5 to 6 to 7, whatever, and keep going until it hits that goal. So you can't, if you just walk away with that, do not assume huge rent bumps in year one. You've already made back the time that you've spent here. Let's just run through real quick. If you're buying a 50-unit complex, then it's at an 8 cap. And if you're just off by $25 a month in your estimate, just $25, and divided by an 8 cap rate, you've lost $187,500 in value. So how would you feel if you bought a property and your numbers were off by only $25 and you lost $200,000? You wouldn't be too happy about that. So make sure you spend most of your time verifying your rents, and you verify them with real numbers based on other properties in the area and the target property that you're analyzing. Start with those numbers and do not assume massive rent bumps. Now, the next most important thing is your operating budget. And going from residential to commercial, this is probably a lot of residential people can really analyze good rents, and that's great. But where they really fail is operating budgets. Because on the residential side, we use a lot of rules of thumb, like the 50% rule and such. And people just assume that the expenses will be a certain amount. And it just doesn't apply the way that you think it does. So you need to build a good operating budget. And a good operating budget is built from a number of pieces. You got your payroll, repairs and maintenance, contract services, turnover, insurance, taxes, property management, advertising, leasing, administrative, utilities, and reserves. Now, these are industry standard numbers. So if you ever talking to anybody in the commercial space, these are the buckets, quote unquote buckets, that we break all of our expenses down into. We do not break them out into other buckets, more or less. This is how it's broken down. So write these down. I'm going to leave it up here for a few seconds while we talk about it, because if you miss any one of these, you'll be way off in your numbers and you're going to lose a lot of money, right? Imagine if you had repairs and maintenance, but you didn't have contract services, right? We're going to get into each one of these, what they are, but just imagine missing one and you're losing hundreds of dollars a month per unit in expenses. You're talking millions of dollars in value, or hundreds of thousands of dollars in value if it's smaller, that you've missed. Payroll. Payroll is the cost to pay all of your employees. Now, most of you don't have employees. In residential, you definitely don't have employees. But on any commercial deal of any decent size of 60 units or above, roughly, have staff. They have somebody there to do maintenance, even if it's just part-time staff. Somebody's there to do part-time staff or leasing, right? Now, if you're doing residential, you're not going to incur any payroll. Like we said, if you're doing a 10-unit deal, you don't have payroll. But once you own a lot of properties in one area, or you own something that's at least probably 60 to 70 units. Now, it depends on the market, too. If you're in Oklahoma City, it might need to be around 80 to 90 units. If you're in San Diego, California, maybe it's 30 units because the rent's a lot higher. So it's really adjustable. But the industry standard is around $900 to $1,200 per year per unit that you have is what you're going to consider for your payroll expense. Now, the reason why I'm giving these rules of thumb is because when you take the seller's T12 is the trailing 12, and that's the previous 12 months of income and expenses that they show you to justify their price. You're going to look at that and you're going to say, well, what's your labor cost? If they say it's $500 a month, you're going to be like, well, that's BS. That's not true. Nobody runs a property for $500 a month. And if they do, they're probably running it into the ground. And you're going to have to discount that property because they're probably not maintaining it properly. Next one is repairs and maintenance, R&M. Now, that includes all your miscellaneous expenses that you might incur on an ongoing basis, such as faucets and toilets and gutters and broken glass and all that other stuff. All the stuff that needs to go on around your property day to day. Now, repairs and maintenance is conducted generally by your staff, and rule of thumb is $300 to $500 per unit per year on average. Now, these numbers are a little bit fungible, right? So you could have a lower labor cost but a higher R&M, right? It depends on how they're doing their books. Now, some people try to hide numbers and move them because dollars are very fungible. So you got to be able to track these when you're going through their expenses and understand, well, okay, they got $700 a year on R&M, but they're only doing $700 for labor. Obviously, they're just moving numbers on their books, maybe for tax write-offs or whatever it may be. Next category is contract services, and this includes everything that you're paying on a contract on a regular basis that your staff is not doing, such as pest control, lawn care, snow removal. Trash usually goes into utilities, but it can go into contract services. There's really a lot of this stuff that if you have an ongoing contract, you need to include it under the contract and services or contract services. Generally, it's $200 to $300 per unit per year, but it can vary widely because a smaller deal is going to have more contract services and less payroll and R&M. So if you have 50 units versus 200 units, you're going to have way less staff on a 50-unit deal. So you're going to end up contracting out a lot of your repairs and a lot of your turnovers, and all this stuff are going to go out to contractors. So that's going to fall under your contract services rather than under your labor or R&M or turnover expense. A lot of times we like to look at them kind of as a group. Turnover, and this is the direct cost associated with cleaning out a unit, painting, patching, repairing, and turning it over for a new tenant. Now, if you really think about it, anybody who owns property, go ahead. If you own property, you've ever turned it over, write it in the chat for me because I want to see how many people we have here that are current landlords. It costs around $1,000 to $1,500 for a turnover. Tell me, am I wrong? Has anybody done a turnover? Give me some comments over here. So the cost per year is really going to depend on how many turnovers you got planned. So if you just bought a property and you're going to just completely turn it over and you got 50 units and you plan on replacing all 50 people, and you're going to do it in the next 2 or 3 years, your turnover expense is going to be very high, right? Because you're talking $1,000 to $1,500 per unit times 50 units over 2 years. You're going to have a different turnover number than somebody who buys a fully stabilized property that needs very little turnover, and they're only turning over maybe 15% of their units in a year, 20% of the units in a year. So you have a way lower turnover. So if you plan to turn every tenant over in 4 years, you budget for around $250 per year in turnover expense, right? That's 1,000 divided by 4. Now, like I said, if you're seriously bumping rents, you're going to increase that up, especially at the first couple of years. Insurance, it's best to get a quote because the costs are going to vary greatly. If you're in Florida, high insurance market. You're in Texas, high insurance market. You're in Minnesota, it's not a high insurance market. There's a lot less disasters that happen in some states than in other states, right? And also, interesting thing, more units you have, the cheaper your insurance gets. I just switched my 35 units up in the Northeast over to a single policy, and I cut my insurance rate by about 20% by doing that, because instead of looking at each individual property, they looked at the entire portfolio, and I got a huge reduction. Now, that's the same thing when you do a 50 or 100 unit complex. You get way cheaper way cheaper insurance, than if you just had one or two buildings, right? So think about it this way. If a single family costs $1,000 per year to insure, a two family might cost $1,300, and a three family might cost $1,500, and so on and so forth. And so the cost goes up for every unit, but the cost per unit goes down, right? So you got a three family, $1,500 a year is $500 per unit. And it averages out when you get into really big properties, 100 units up, to be somewhere between $250 and $350 per door. And again, depending on your market. Taxes. Never, ever use the current tax rate in your calculations. People tell you I'm spending $10,000 a year in taxes, so include this in your numbers. Screw that. Throw that out, cross it out, forget that it exists, delete it from your memory, whatever you got to do. It's not accurate, because what happens most of the time when you transfer property, the city assessors know that it's been transferred and they reassess it at a higher rate. It's just what they do, because cities are driven off of property taxes. So every opportunity to get to jack up your taxes, they do it. So always assume the taxes will bump based on the new purchase price, unless you have a really, really, really good reason not to. If you're buying it for less than what they purchased it for just a year or two ago or something like that, okay, then maybe you don't do that. Then you're just probably getting a good deal. Most people are not buying a property for less than what the previous owner got it for a couple of years ago. Most people aren't doing that. So you need to assume your taxes are going up. If you do not assume that, you're probably going to end up losing out, and you're going to really mess up your operating expenses. Property management, even if you self-manage, you need to include this in your costs. So even if you're doing deals near you, including it, you need to pay yourself for your work. And you may not always want to manage it. So build it in now, because in 3 years, when you decide to turn it over to a property management company, you want those numbers already built in. The more units you buy, the cheaper management gets. This is why commercial multifamily is better than residential, because at a one unit, you got one property, what are you paying, around 10%? Between 8 and 12, it depends on the unit. 20 units is going to be around 8%, 50 units at 5%, 100 units at 3.5%, 200 units, 3%. I've seen some places at 2.5% management rates when you get up well over 200 units, right? So that cost, it just goes down and down and down the more units you get, because you're just getting that benefit of having the extra units and reducing those costs. Advertising and leasing is another one. We're getting towards the end here of these particular, the subcategories, the sub-buckets. Advertising and leasing is different in multifamily than single family. So in single family, you're probably paying a leasing fee to a realtor. Well, you're not doing that in commercial real estate. You've got staff. So advertising and leasing is more geared towards marketing, brochures, snacks, drinks to your prospective tenants, quarterly resident events, right? So when you have your barbecue every quarter, for all the residents that live there, resident appreciation days, that all goes towards your marketing budget, your advertising, leasing, marketing. A lot of people call it marketing. Now, it really depends on the size of the location and varies dramatically from $50 to $300 per door. Now, if you're on a major road that gets 100,000 cars a day, and you can just put a really nice sign up front, and people will pull in and rent from you. Now, if you're not on a major road and you're back from it a little bit, you're gonna have to do some advertising. You're gonna have to get word of mouth and stuff like that a lot more. So you're gonna bump up closer to that higher end. Admin costs is commonly overlooked in a residential space. It includes evictions, accounting, notices, printing, mailing, rent collection, etc. Right? So most people, when they're buying residential property, are not counting the cost of evictions into their monthly operating expenses. But if you really think about it, the law of large numbers tells you if you evict 1 out of every 100 tenants, if you have 100 tenants, you're going to evict somebody every year. If you have a single family, it's going to take you 100 years. I mean, you know what I mean, right? So you're not really building it into your cost when you have a single family, but when you have a lot of units, you can build it in. It's just cost of doing business, and you should build it in. And that's between $150 and $225 per door per year. Now, utilities. You take anything you can from the city, sewer, water, and add in whatever the seller is reporting as their expenses, right? So you can't estimate this because it really depends on so much, including what type of heating and cooling systems they have. But as a rule of thumb, do not ever assume you can run the building for less than what the current owner is running it for, unless there's some serious investment that you're making, such as water-saving toilets, put in xeriscape in instead of lawnscape, things like that, which are going to really reduce your water usage. Those things you can include in your budget, but make sure you budget out over the course of 6, 12, or 18 months for it to be implemented, right? But in general, do not assume that you can operate it for lower utilities than the current owner. Now, reserved capital expenditures is another really overlooked item in a residential space. Okay, so without getting into all the details, you're going to need to save between $250 and $300 per door for your capital expenditures. Now, this is your roofs, your siding, major exterior paint, driveways, parking areas, exterior lights, water heaters, HVAC, things like that are all part of your CapEx, and or your reserve budget. Now, if it's older, I know a lot of properties 100 years or older, it might be $500 per door per year on those really old properties if they need a lot of work. But here's interesting about commercial finance. A lot of times these commercial lenders will require you to carry $250 to $300 in reserves per year per unit in order to do capital expenditures. But the interesting thing is they don't like to release those funds to you. I don't know why, but if you say, oh yeah, we just did all the whatever HVACs, if we did 50% of the HVACs cost us $75,000, can we have 75 grand? They'd be like, no, we'll give it to you when you're all done. And so you might have another year or two to finish the other ones, get up to 150 grand before they release any of that fund, those reserves actually release it to you. So you're paying that out of pocket. So most investors doing any deals of this size are actually oftentimes double counting their reserves. They're counting $300 a door for reserves, but then they're also including that all in their rehab budget up front because they don't know if or when they're ever going to get that money. I mean, yeah, you always get it on the sale, right? Because it's your money. It's held in some sort of escrow account. You get it on sale. But many people, as far as their operating budget, are just including it no matter what, even if they've already set it aside in their rehab. Now, getting into rehab budgets, it's really hard because you can't bring a contract with you in your pocket everywhere you go. So the key is to get a rough idea of the rehab that's required, deferred maintenance, etc. And often the broker will have a good idea. They're going to tell you it needs $3,500 a door, $5,000 a door for renovations. And if you're doing single family, you wouldn't say something like that. But when you got 100 units, it averages out. So maybe one unit needs $500, but another one needs $8,000, and you kind of average it out. And that's kind of where you're going to get your first number from. But as you do your due diligence, the diligence team will be able to give you really good estimates on your rehab costs. Now, but during your analysis, you don't have that, like I said. So we're going to plan for $3,000 to $7,000 per door, depending on the size and the scope. So if you got really, really small studio apartments, you're going to want a lower side. If you got mostly 3-bedroom apartments, you're going to larger side. If you're just going to do a basic, maybe vinyl plank floors, paint, and some light fixtures and plumbing fixtures, then maybe you go around $3,000, $3,500. If you want to start doing cabinet faces, backsplashes, new countertops and stuff, you start pushing up towards the $5,000 range. You want new appliances, you bump that up to the $7,000 range. And so it really depends on the scope of what you're doing. A lot of the stuff we invest in is kind of the C-class property. So you're not doing these super high-end renovations. You're just making them nice and livable. But if you want to do something that's like on a higher end, or do a reposition from a C to a B or a B to an A, then you're going to end up on a higher end. Now, that doesn't include, that number right there doesn't include your big ticket items such as your parking lot roofs and HVAC and such. You really have to estimate that on the side. And it's okay to be more conservative. It's better to not be aggressive on this. Now, the other thing was market value, right? We need to estimate market value, and it's really simple, kind of in a way, in commercial real estate, because market value is a simple formula. It's just the net operating income divided by the cap rate. And NOI is just your total income after all of your expenses, not counting your debt. You do not count your principal and interest. And you should also take the necessary repairs off the top. Now, this is not your desired upgrades. This isn't your internal renovations, such as like replacing whatever, doing backsplash and jacking up the rents and stuff. This is like major renovations, like roof and stuff like that. You should always deduct that from the market value. So those are the 4 fundamentals. Now, so the things that you need to win are building relationships, choosing the right markets, partnering, knowing your numbers, and building relationships. I think I already said that, right? So those are the fundamentals. Now let's dive into some examples. All right, let's go through an example. This is a 7-unit building, total rent, $5,257. Its reported expenses were $2,048. This is monthly, so the yearly NOI was $38,500. The asking price was $385,000, which is a 10 cap. Now I know this market, and it had a potential value on the market. Rents should have been around $6,075 per month. So we're about $800, give or take, below market value, which is a huge amount for a property of this size. But my first thoughts, the expenses are only 39% of the current rent. Now this is doable if you're not counting property management, right? So 8 to 10% for property management, that puts you around 49%. Now, if you don't know what I'm talking about the the rent to expense ratio. You see, take your total rents and you see how much your expenses are of a percentage of that. So we had 2,048 was the expenses, 5,257 was the rent. When you do the math, that's where you get the 39% number. Now, again, this looking at the 50% rule. That's just a rule of thumb, and it doesn't always apply. But here's the thing: is once we adjusted it to the market rents, because we knew it was below market value, it's only 34% of the market rents. Now, I know things don't usually follow the rule of thumb and 50% rule. I've never seen a deal actually run at exactly 50%, but 34% is really low. And so it didn't seem to make sense. So let's run through and build a pro forma. Now, pro forma is just what you believe that the rents and expenses should be under ideal circumstances, right? So here we are. So this is a copy out of my personal spreadsheet right here, and you can see I break it down by the type, the 112131, and square foot, total number of units. You can see if you add up the total number of units, there's 7. Now on my spreadsheet, I do things a little different. I look at the number of non-renovated units and the number of renovated units. Because some buildings, especially in commercial space, when you're dealing with 7, 10, 50, you have a 50-unit complex, chances are some of them have been upgraded. Not all of them, but some of them have been. So you got to be able to differentiate what should the rent be on the upgraded ones versus the non-upgraded ones. So what I do is you put the number of non-renovated units there, and then you put the total number of renovated units there on the right-hand side. You can see the current rents, and then you can see the renovated rents. And then the combination of those gets you up to the current rent value. Now, if you moved everything over to the renovated value, you would end up with the second number that I gave you, the higher rent value. And so we're just beginning to break down what our rents should be. All right, so now we're going to go through our pro forma expenses. Now, like I said, the 2,000 and whatever they had didn't seem to make sense. So I broke it down into my 11 buckets. Now you can see that I don't really follow the numbers because this is a small deal. So we have no payroll, and property management is going to be higher. Now I get good property management rates in that area because I own a lot of property. So so the numbers are a little bit different based off of my current portfolio in that area, right? So your pro forma expense should be based off of your experience of what you know to be true in that market. And if you don't know anything in that market, then that's when you go to the industry standard numbers, right? That's just that's like the 50% rule, but you break it down for each one. If you know nothing about it, you go to the industry standards. But I know a lot about this market, so I really know what it costs me to do repairs and maintenance on these types of buildings and such. And I was coming up, just say $3,200 a door. Now, in a given year, that's only about $3,000, $3,500 difference for the entire property. But if you really think it doesn't sound like a lot, $3,000 is not a lot, but it's really 10% of the property's value. So we're talking a difference per year in the expenses of 10% of its entire value, which is really quite significant when you look at it in perspective of the size of the deal, right? And that's why it didn't make sense. Now, like, I don't like to be picky about $3,000 usually, but in a small deal, $3,000's a huge amount. So let's estimate the price, quick and dirty. 10 cap. Let's assume that that's accurate. The NOI is going to be 63,000 minus our vacancy expenses, 6,300 minus our expenses. Now, vacancy. Let me touch upon something that's different between residential and commercial. In commercial, we use what's called economic vacancy. We don't use physical vacancy. So physical vacancy, a lot of people use like 5 or 7%. Economic vacancy includes a lot of other things. A loss to lease. So if your unit should be renting for 800, but you negotiated a deal and you got 775, that $25 is considered lost rent. That's considered vacancy, and that should be built into your vacancy number. When you go through an eviction, you have debt that's owed to you and it's not paid. That's considered vacancy. So we build all that into our vacancy number. In properties that are C class, it's usually 10 to 12% in most markets. You can go a little bit lower in B class properties, but in C class properties, it's going to be 10 to 12%. And so our NOI is 36 grand per year. Now, at a 9.5 cap, that's 302,000. I don't know why I changed from 10. I know this market's a 9.5 cap, so I don't know, but I don't know why I wasn't consistent with these numbers. But it should be worth around $302,000 based off these numbers, based off of my knowledge of the expenses, the income, and the vacancy. Plus, it needed around $60,000 in rehab. So we're way off. This isn't going to work. So normally in a deal, you would move on. You do your quick numbers, which you can do on a napkin or whatever, like they call it napkin math or quick and dirty. You can do this stuff really fast. And I knew that we were $80,000 off. Should have walked away, but I really love the area. I own a ton of property right in that area. So I want to do a little bit more further detail. And I did end up making an offer on this deal. I didn't get it. My final offer was $325,000. And I tell you how I get to it. So in my advanced calculator, basically I like to look at where my returns will be in 5 years, roughly. And so basically, what is my overall return? I want my cash on cash return. Here, I'm just going to use my mouse. Hope you guys don't mind. You got your cash on cash return number here, and you can see what your yearly cash on cash return is. You can see it's decent as you go on, right? Year one's not that good, but as you get on, it gets higher. And then I like to look at the total return number. And after 5 years, my total return, now that includes your cash on cash return plus any money from your sale, was 112%. So basically, if I invested 100 grand into this deal or whatever, by the end of 5 years, I should have like 220 grand total. So I should a little bit over double my money on this deal. And that's really like how I like to analyze these deals over a 5 year. And that's how you can give the best offers. And you can play with those numbers in the calculator. You could try with a 305 offer, 310, 350, whatever, and you keep doing it until this total return and cash on cash number are where you want it to be based on your specific criteria. If you only need a 12% cash on cash, you can offer more. But if you want higher cash on cash, you offer less, right? So that's why going through, and now this is really simple. The numbers, like my spreadsheet is like thousands of cells. Like there's so many numbers in there, and then I just consolidate it into this thing so it's easy to see. So it's easy and quick and easy for me to get at it.
Hey, Eric. Real quick,
what's up?
We had a great question. Why is the economic vacancy declining over time?
Okay, so so basically what you do is you work in the plan based on your strategy. So my plan on this particular property is to come in and do some major renovations and turn over some units. So what that's going to cause is a lot of turnover. Higher turnover means higher vacancy. And then when it was fully stabilized, it was going to be repositioned to a higher end property, one of the best properties in the area. So like I said, a B class property could probably be around an 8% economic vacancy, whereas a C class is probably 10%. In year one, I assumed I was going to do a lot more turnover. That's why I bumped it to 15%. And then by year three, it would be fully repositioned to a B class. And that's why I would stabilize at about 8%. Does that make sense?
Yeah, and then it looks like your total other income, so you're not factoring in anything for pet rent or utility bill back, parking, anything like that. You just didn't feel like this property had those options, or were you just trying to be more conservative on your numbers?
Yeah, so there's a couple things. So this doing some billing things for parking stuff doesn't work on smaller multifamily. It's really hard when everybody knows each other in a complex to bill, right? Because they're going to cover for each other. So that sort of stuff doesn't work, and where you can get away with that in a 50-unit complex, charging for reserved parking and stuff like that. The other thing is in Massachusetts, where this deal is. You're not allowed to charge pet rents in utility bill backs. There was room for a laundry facility, but I didn't factor that in, just to be a little bit conservative. So I just left it at 0. So I mean, like something like laundry, it's really hard to analyze what your laundry income would be on 7 units, right?
Sure.
Because it's just like a small number. So
Makes sense.
any other questions on the specific numbers on this? I mean, these are great questions, right? Stuff I wouldn't have thought to mention.
Yeah, so here's a really good one. And actually, this is one that was in my mind too. So how is the exit sales price being estimated every year?
Right, so the exit sales price is estimated based off of the NOI of that specific year and the cap rate. Now, you'll notice the NOI, like for example, is 37,865. My exit sale price is 378,646. That's basically a 10 cap. I mean,
so you're planning an exit with the 10 cap, and then as your NOI is improving every year, then that's why that number is going up.
Exactly. So on this market, I was assuming a 10 cap exit price. Now, this is each one of these years is if you sold it in that specific year.
Sure.
How much you would earn. And so on this, it's a exit, assuming, again, nobody knows what the cap rates are going to be in 5 years, right? So you can only guess. And because you have to have something, you have to put something there in order to have any idea what's going on. So I put something there. The cap rates could be 8, they could be 15. I don't know. But you got to have something to run numbers. But yeah, so basically NOI is improving every year because I've brought it and stabilized. And you see the first 3 years, there's dramatic increase up to about 43,000. And then there's very, very small increases. And this is just economic assumptions, which you can't see here, but in a calculator, you can input economic changes based off of rent increases, expense increases, and you can kind of model in some things based off of what you think is going to happen in the economy. If you thought there was going to be a recession in year 2, you could model that in by saying there's negative rent growth year 2. And some people do that. But that's why you see an increasing number, and you also see increasing expenses every year because things get more expensive. Materials go up, labor goes up, etc.
Why don't you, this is something that was kind of new to me, was the break-even occupancy. I mean, it obviously, is pretty self-explanatory, but why don't you explain that real quick?
Yeah, so we love to, in commercial real estate, look at break-even rent and break-even occupancy because it's a stress test. And the idea of it is if the economy turned tomorrow and everything went to crap, if my rent stayed the same, how much vacancy could I have in paying my debt service? At least pay the mortgage so I don't lose the property. Right? And that's what the break-even occupancy is how do you not lose your property? Now, that's not where you want to be. You want to earn profit. And so in this, you can see that it hovers, give or take around 60%, which is a pretty low number. That's a good number. And so I could lose 40% of my tenants, or in this case, three tenants to 4 tenants, and 3.5 tenants, 3 tenants, and still pay all my bills. I can lose a huge portion of my tenants. Break-even rent is if I was at full occupancy, 100% occupancy, what would the average rent need to be in order to break even? And so there's 2 different ways to look at it. So we know if the average rent was $800, I could cut my rents by a third and still break even. That's a good position to be in a property like this. Now, I was taking on a lot of a risk with some aggressive assumptions, right? I was assuming, remember I said, never assume huge rent bumps in year one. And I was assuming some large rent bumps in year one, right? So I'm breaking my own rule. But I was offsetting it because I was having an expectation of high returns. 18% return is high. In any real estate, any sort of investment, 18% is high. And basically I said, if I'm going to take this risk on, I want high returns. And that's where I came up with the 325,000. When I punched it all in and I played with the numbers and I said, I can get between a 17, 18% return per year once it's stabilized. I feel okay with the risk that I'm taking on for my assumptions for that potential return. And that's based on my personal criteria. Every person I'm talking to will have a different set of criteria. So what's comfortable for you will be different. And that's okay. But this is what I was taking on, or what I was assuming. Now, like I said, I didn't get this deal. Somebody else had different criteria and they paid more and they got it. But I wasn't comfortable paying more. All right, let's go into something a little bit bigger. Also commercial multifamily. This property right here, 94 units with gross potential rent close to $1 million a year. This is all yearly stuff. Reported expenses, $585,000 a year. And it's being sold at a 5.5 cap, roughly. Asking price, $5.25 million. NOI, $285,000. So you could do the quick math. The $285,000 divided by the 0.054 will give you that $5.25 million. Now, there was some value add. The potential market rents could be $88,000 per year, which I didn't break it down monthly on that, but I'll just do it really quick. 980,712 divided by 12 is 81,700. And the market value is 88,700. So there's about $7,000 a year in potential rent bumps that we weren't getting they weren't getting on this potential deal. So there's some value add, not a ton, a little bit. So there's not a lot of risk, right? This is a very well maintained property. You can see it looks good. Not like the previous one. This one looks nice. It's basically fully occupied, like 95% occupancy. It's a good property, low risk. So, just based off of risk return, you're going to expect lower returns for lower risk. And there's very little major repairs required. So we're going to build out our pro forma on this again. So I go to unit by unit and the number of non-renovated units. Now this one had no renovated units and it's all considered the base model. Now they did basic turnovers, replaced the carpets and painted when there was tenant turnovers and stuff like that, but they didn't do any major upgrades on it. And this is the rents they're getting. And then on the right-hand side, you can see the assumed rents, what we could be getting, and then obviously 0 of them are renovated. And you see there's not major rent bumps, right? You're talking going from, for a 2-bed, 1-bath, going from about $930 to $1,000, from 780 to 850. I mean, these are not dramatic rent bumps. That's because this is already a very well-maintained property. You wouldn't expect that. Lower risk too. So we're going to build out the pro forma. We start with what they provide, and then we start doing some adjustments off of it. And without running into it, you'll notice that on this, I thought the management expenses could be a little bit lower. We had $557,000 versus $585,000. So we believe that we could get some savings when we really went line by line and went through the whole thing. There's some areas that there was good room. And we also talked to the property management company who verified our numbers. And that's how we came up with this number. Now, normally you don't like to assume it too low, but if you need to make aggressive offers on decent, safe, low-risk properties, you really got to hone in those numbers. So let's go through the quick and dirty. So just assume a 6 cap. Make it easy. They had $980,000 minus the vacancy of $98,000 minus their expense of $557,000 is giving you $326 NOI. At a 6 cap, that's $5.4 mil. Now it did need some improvements, about $340,000, and I know I said there's not a lot. There's really only 5% or 6% of the entire purchase price needed for major improvements. which if you really think about, that's not that much, right? The 60 grand on the 300 something thousand dollar property is like 20% of its value needed for renovations. This one needs like 5%. So when you look at it as the size of the deal, that's a small number. So it's coming up with about 5.1 mil, which is right in the ballpark of what they're asking at 5.25. So let's refine the offer. Let's find the number and make an offer. Final price, we came up with 5.25. Now, how do we do that? Again, we're looking at the spreadsheet. We want to figure out what we would feel safe with as far as cash on cash return and overall return. And here it is on the right-hand side. Now, the cash on cash return is 11% by year 5. Year 1 is only 3.5%, which is pretty low. But you're willing to accept a little bit more risk, a little bit lower return because it's such a low risk property on that first year. But the overall return is only 92% in 5 years, so it's 30 percentage points lower than the other deal. But it's a low risk deal, very stabilized, no massive increases in vacancy were required, no major rent bumps. So if you're really looking at it as far as a risk-adjusted return, it's very, very attractive. Because once you adjust out the fact that there's so little risk in a deal, 11% return per year is really attractive for the low level of risk. So we were feeling comfortable with that. But when we started bumping up more above that, we weren't really achieving the numbers because though the cash on cash return was okay, the overall return was starting to get kind of low. And so there wasn't a lot of equity being built in the property. So 10% or 9% cash on cash is okay, but if you don't have a ton of equity, a lot of equity being built up to offset that, it's not really that attractive. So when you're looking at both numbers, it wasn't reaching the numbers the goals that we wanted. So we ended up with 5.25. And again, we didn't end up getting this deal. Somebody paid about $75,000 more than we did. But you know, and that's one of the fundamental things about real estate is you got to come up with a number based on what you're comfortable with and stick to it, not based off what somebody else is comfortable with.
Hey, Eric.
Yeah.
Really great question from Dave. How do you determine whether any of the units have been renovated? Do you just depend on the seller's info until due diligence and then you confirm that, or how do you know that going in to this analysis part?
Yeah, absolutely. So that question, if there's renovated units, the seller really wants to tell you because that increases the value of their property. So they're not going to hide that. In fact, the problem should be that they're telling you they're renovated when they're really not that renovated to any level that you want them to be. But to get more into your question, you're not going to see all 90 whatever units. Usually you can see maybe if they have a model unit, and if they have any vacancies, you can look at the vacancies usually. So you might see 3 or 4 units when you do your initial walkthrough. Then you'll present an LOI, a letter of intent. And then if that's accepted during diligence, you can do a full walkthrough where you look at 100% of the units and verify all of your assumptions. Does that answer the question?
Yeah, I think so. And then I think the other question, we're of course talking about these deals where you have offering memorandums and, potentially sophisticated sellers that know, what a buyer would need. In a situation where it's an off-market deal with maybe a retiring seller that has, less than professional bookkeeping, how does one get around, those kind of things? At that point, how do you, I'm thinking about some of the deals that you and I have been evaluating over the last couple of weeks, right? And that's been part of the challenge is we don't have an offering memorandum from a commercial real estate agent. We don't have a lot of the things that you're discussing here. And my guess is that maybe some of the other attendees are kind of going through some of that as well. What would be your suggestion on that?
Yeah, so basically that is that's about perceived risk, right? So most people are not super professional unless they're getting well over 100 units, and then they become very professional. Even then, a lot of times just wealthy individuals buy those properties, and a large amount of time they're not very as sophisticated as you think they should be. And brokers spend a lot of time putting these numbers together to present to you. Now, if you're bypassing that and you're going straight to seller, or you're finding them kind of off-market pocket listings or whatever you want to call them, you don't have that level of where you're more sure of the numbers. And so what that does is it increases your perceived risk. And so even if the deal is equally risky as another deal where you have the full offering memorandum, the full T12, a broker backing it up, multiple levels of people looking at all these numbers, and then you got this other deal, the exact same deal from a different seller, the exact same numbers, but because they cannot provide them to you in a way that you can read them and understand them, you perceive the risk is higher. So when risk is higher, what do? Well, you got to change your return expectations. You do not take if you would take an 8% return on a low risk deal with the broker with the good OM, the good T12, and a great location, and then you got the same guy next door who can't give you any of that, and you can't make heads or tails of his numbers, you're not going to take an 8% return. You're going to have to bump that up to offset for your perceived risk because you don't know if there's any numbers hidden in there, some catastrophe, some problem. So maybe if you would have taken 8%, maybe you say, well, I'm going to do 10%. And so you play with your final price number until you bump that cash on cash or overall return or whatever it is that you've adjusted it to until you get up over that number. And so that's kind of how you come up with it. And so for these off-deal markets or off-market deals, I usually have to offer lower. There's a little bit because you can pay a little bit less if there's not a broker involved. You can pay less. You can take some of that out, and it helps both parties. But usually, you just gotta give a lower offer unless they can give you all the numbers you really want and need in a way that you need to see them.
Great. So we have another really good question. So what are the factors that give this property a lower risk profile as compared to the prior property? You didn't say location.
Yeah, okay. So this particular property was in, I believe it was Irving, Texas, which is in the Dallas-Fort Worth market. Major metro area, massive growth, had high 90s occupancy, like 97% occupancy. Almost all the rents were at market rate for what they should be. The rent bumps were coming through renovations, it was at market rent. The market rents for renovated units is what the new market rent should be. So if you have all the upgrades, you expect to charge more rents. So it was a very, very well stabilized property. You could buy it, do almost no work to it, and let it run just the way it was. That's why it's lower risk. Now the other deal was 120 years old because it was in New England. It was in a small market town, about 20,000 people, not a lot of high-end workers, kind of low C property. The tenants in there were probably D-class tenants. A lot of them were on Section 8 that needed to go. So there's a full turnover you need to do of almost basically 6 out of 7 tenants. It was being managed very unprofessionally. So there was a lot of physical work that needed to be done. When you start doing major renovations, you incur risk because you don't know what the building inspectors are going to make you do above and beyond what you've assumed you were going to have to do. So you assumed you're going to have to do the service panels, for example, but then it turns out they want you to rewire a number of apartments because whatever reason, so you start building on these expenses that you never expected. So that's the risk profile of this property is much higher when you start considering all those things. Now, if there's so different markets, so different property. What would be micro adjustments on the risk would be like, better or worse part of the town, location near major highways or major roads. The tenant profile, if you have, better working class people versus like lower end people, students are higher risk, military, even though I'm a military guy. Military provides risk because they tend to get activated and sent overseas, and there's nothing you can do about it. So you get vacancy that way. All those things anything that can affect your bottom line is increased risk.
This next question is perfect. So can you share your analyzing calculators? Would love to have a template.
Here, how can I help you? I know I tossed a ton of information out there and I blew through some examples, and now I'm getting back to the calculator. Now, if you want my personal deal calculator, I basically give it away, honestly. Most people are selling these things for like $200 plus. I know a lot of people do their deal calculators for like $200. I'm going to give it away to you. I literally practically give it away, but I have to charge something for it because I spent hours and hours and hours and hours and hours building this thing, and I refine it almost every week. I'm making some sort of adjustment to it. So if you're actively looking for anything that's 2 units to like 200 plus units, this calculator works for you. If you're planning on investing in another person's deal, this calculator works for you. If you're doing flips, this calculator does not work. I mean, it does work. You could do flips in it, but it's really not designed for that. If you want it, like I said, it's cheap money. Normally, I would do it for about $70. I'm giving away because you guys are all part of Jennifer's network. Jennifer's amazing. So for $35, I'm giving it to you. Like I said, to me, that's giving it away. I mean, you couldn't give it. I'd give it away for less than that. It's so little money. So if you really want to go to idealrei.com/calc, and that'll get you right over to there. You can go ahead and grab that. So I see another question over here. What's that? Yeah, that's a really great question. Can I jump into that a little bit, Jennifer? All right, I'm just gonna
Sorry,
go
I had myself on mute. Yep, go for it.
All right, so target metrics, debt service coverage ratio. So debt service coverage ratio, for anybody who doesn't know, is how much your income after expenses covers the cost of the loan, principal, and interest. So target metrics should be based, for DSCR, is based upon what your bank or what your lender is providing now. Industry standards somewhere between 1.2 and 1.3. I can tell you the agency type debt, like Fannie, Freddie, non-recourse loans, stuff like that, is doing 1.25. So if you can't get into a deal and hit that, then you need to adjust your number, or you got to pay more on your down payment. So a lender will say, hey, at 20%, whatever, your 20% down payment for this Fannie Mae loan, non-recourse, $3 million, it's only at a 1.2 debt coverage. So instead of offering 80% leverage, we're going to give you 77% leverage, which bumps the debt coverage ratio up to 1.25 or whatever. So the goal is you got to make sure you're hitting that 1.25 conservatively. And if you're less than that, you got to figure out how much more down payment you got to provide in order to get it up to that. Now, cash on cash return as a metric is a number that changes based on the market that you're in the market, part of the market cycle that you're in as well. So for me, if I'm investing in like a Dallas, I have a much lower cash on cash return goal than if I'm investing in a Memphis, right? So if it's a core market with solid fundamentals that I know that basically no matter what happens, I'm not going to get wiped out. You may lose money. You can always lose money. But in my opinion, I don't think a deal in Dallas is going to get wiped out. Then you can go 8% cash on cash return. But if I'm going to a kind of lower end market that's doesn't have the fundamentals that like an Orlando has or a Dallas has or something like that, then you're going to want a 9 or a 10% return. And that's also going to depend on what class property. If you're doing a B class property, I love B class properties. You can definitely do like an 8% return. The deal Jennifer's in with me is only about an 8.5% return, projected between 8.5 and 9, I believe. And that's a solid B, mid-80s product though in San Antonio, which is a really solid market. Now, if you took that exact same property and you dropped it over on the south side of Dallas, which is really a bad neighborhood, or you put it up in Kansas City or something like that, you're going to want 10, 11% on the exact same property. So I can't give you an exact number because it's a sliding scale. Rent to expense ratio, that is a number, that's a rule of thumb. We never use that in final numbers. So the 50% rule, for example, is just an idea to see if something makes sense. Are they at 30% expenses? Then they're way out of the ballpark. Are they at 70%? Then there's probably a problem too. But usually properties run between 45 and about 60%, depending on utilities. And return on investment, again, that depends. Like I said, that depends on the market. You can do anywhere from about 80% overall ROI in 5 years to about 120%, depending on your market and where you are in the market cycle.
Yeah, and I think that was a really great question. And with the rent expense ratio, I've been using that on the deals that we don't have clean financials on, just to see if it's even worth trying to get the clean financials. So it's pretty easy to figure out what the rents are. If they have at least a rent roll, then you can make some assumptions on the rent expense ratio and then decide, okay, is it worth submitting the LOI and then saying, okay, seller, here's the list of everything we need from you.
Yeah, something like that is really good, especially in the smaller deals below 100 units where you're working directly with the seller. Um, like you said, like I showed you the quick and dirty analysis. It's like 5 lines, takes you 2 seconds to do it. Just drop in a 50% expense on there. Are you within 20% of what they're asking? If they're asking 3 million and you're at like 1.8 million, like just don't even waste your time on them.
For sure. And on a side note, if anyone is looking for deals, I've been getting quite a few smaller complexes lately off market. I had a 57 unit, I guess it's not super small, but 57 unit in Spokane about 2 weeks ago, another 44 unit. And then my inbox is full of basically 6 to 20 unit properties in Oklahoma City right now. So I'm doing a lot of work, just so that you guys know, with a lot of our agent partners and Agents Invest, that are finding a lot of smaller off-market multifamily properties, and they're just sending them all to me, and I'm deciding if it makes sense or not. If it does, then we have some people that are trying to line up 1031 funds, or people that are really motivated and ready to go. So if you guys are looking, definitely reach out and let me know, because like I said, I've got an inbox folder just full of deals right now. And I'm just, kind of going through all of these and vetting some of them, because I don't want to, hook you guys up with kind of messy deals. But yeah, so that's my little plug on deals right now.
Yeah, they're awesome. Jennifer's sending, I'm getting deals all the time. We're really looking to try to get something bigger done in OKC. And I tell you guys right now, it's just a matter of time, but you're going to be seeing some emails from us eventually when we get something big going on up there. So.
And then on a side note, I know actually quite a few of the attendees are going to be joining us in Oklahoma City. That is a month away. Actually, it's July 13th through the 15th. I've really kind of fallen in love with that market. And really my fall in love is just based on the numbers. I am very particular about, returns and things like that. Very non-emotional as it relates to real estate. So we have a networking and property tour. We've got investors flying in from Alaska, Hawaii, Washington, California, kind of mostly us West Coasters here. And we're all going to Oklahoma City July 13th through the 15th. Eric is going to be there as well. So if you guys are interested in meeting Eric in person and picking his brain, he will be there. It's going to be a really great time. We have a few tickets left if you guys are interested. I think today is our last day for the early bird tickets. I'm going to put the link in here, but we would love to see you guys here in Oklahoma City. It's going to be a great time. We've got some fun other events planned, but we're just going to be doing just a lot of real estate, looking at off-market deals. We're hoping to actually go through some of these apartment complexes. We're kind of setting that up now. But yeah, so it's going to be a great time. Would love to see you guys. The link is there. And then we will also, this is a recorded webinar. I'm going to send everyone a copy of the recording tomorrow, along with some of the links and more information for you guys. Other than that, I really want to thank Eric. Eric, is in Dallas time zone. So Eric, it is almost 10 o'clock there. I want to thank you so much for agreeing to spend this late night with us here. And I appreciate all of you guys. I've gotten I love everyone's just positive emails that I get. I get text messages, I get PMs, I get emails of just people that are doing really great stuff. And it's fun. It's this little community that we're building. And I love seeing everyone else's success. So I think we're all, able to learn from each other, grow from each other. Again, I love bringing amazing people like Eric to you guys, in a different state, in a different area. So thank you guys. Thanks for spending our time is our most valuable asset. So I appreciate all of you guys. And again, especially Eric for spending your evening with us and sharing your knowledge.
Yeah, thanks so much for having me, Jennifer. I look forward to seeing everybody in Oklahoma City. Don't forget to check out my website, please, if you guys ever want to. You can contact me through there or anything if you ever have a question about Dallas or whatever, or about anything that I have on my website. Thank you.
Awesome. Well, thank you guys. Have a fantastic night. Let's do some deals this week, and we'll see you hopefully everyone next month.
All right.
All
Thanks.
right. Take care, guys. See ya.